Hi, I'm James Dunn. Welcome to the Inside Network.
Welcome to INDepth, where my guest is Zehrid Osmani, Senior Portfolio Manager and Head of the Global Long-Term Unconstrained team at Martin Currie. We're going to talk to Zehrid about the team's unconstrained quality growth approach and insights into the global market. Welcome, Zehrid.
Thank you, James. Nice to be here.
Oh, it's a great pleasure to have you here in the flesh, all the way from Scotland. I'd like to start off, Zehrid, with just asking you, what does the unconstrained quality growth phrase mean in terms of the philosophy of the firm?
Yeah, the philosophy on the quality growth side is looking for companies that have high returns on invested capital and an attractive growth profile. And on the growth side, we're looking at structural growth opportunities, looking ahead rather than in the rear view mirror. So it's about forecasting companies that will be able to harness interesting structural growth opportunities. On the ROIC side, on the quality side, typically profitable growth is therefore the aspect. And the unconstrained characteristic is simply to be unconstrained by benchmarks. So really looking for the best ideas we can find across the market, but focusing on sectors and areas where there's more potential for finding companies that can create value for shareholders. So there are big parts of the market that we don't have exposure to, in large part because we don't believe these areas will create value for shareholders on a sustainable basis in the long term.
Now, obviously, you're very bottom-up in your approach, but what drivers does Martin Currie as a firm see that are favourable for global stock markets?
Well, we have a framework that's focusing on three megatrends, which are demographic changes, future of technology, and resource scarcity. And James, let's hope that you and I are still going to be speaking over the next 10, 20, 30 years with longevity, the way it's going. And over that period, we'll still be talking about these three megatrends. What we do then is we assess themes within each of those megatrends, and we identify companies that are exposed to specific themes that we favor. And that permits us to achieve three things. Firstly, we put our strategies on long-term thematic opportunities that have good structural tailwinds. Secondly, we can manage diversification more efficiently across the three megatrends. And then it also gives us the visibility to look at any themes that we might have research and then orient the research towards that area. So the 8 themes that we favor at the moment can be bundled into 3 big seismic thematic opportunities. The first one is energy transition. The second one is aging population. And the third one is artificial intelligence. So we can go into any of those where there are various themes, but I'll leave it to you to decide.
In terms of numbers of holdings, what are your limits in terms of how concentrated you can be?
20 to 30 stocks is typically what we target. And the reason we do that is to very much deliver to our investors the very best ideas that come out of our research. And I always say that when you have a best idea, you have to harness it properly through appropriately sized positions. So by having 20 to 30 stocks, we're able to harness these best ideas, size them appropriately with the aim to capture the returns potential over the long term. And I should say also our time horizon is 5 to 10 years.
Within your own portfolios, obviously you like concentration, but what's your view at Martin Currie on the concentration within global markets, and in particular in the United States with the Magnificent Seven? Is that a good or a bad thing?
Yeah, it's a good question, James. So clearly that concentration can be challenging for investors, because if you look at the S&P 500, almost 30% of that index is in the Magnificent Seven. If you look at the global index, MSCI Acqui World, it's close to 20% of the index is in those 7 stocks. For us, it's about having a fundamental view and assessing these companies in terms of their growth and returns profile, their valuation upside. So valuation discipline is critical. And I can say that over the period that we've been investing in the markets with global long-term unconstrained, we've been only invested in a few of those Magnificent Seven. And over the past year, for example, we've only had 2 of the Magnificent Seven. And I'm mentioning the last year because the last year has seen a lot of skew in performance towards those Magnificent Seven. So the stocks we had have been NVIDIA and Microsoft. They have served us well in terms of performance, but it's all been driven by fundamentals. And at the same time, the reason why we don't have the other 5 of the 7 is for fundamental reasons.
What becomes the reason or the catalyst to sell a stock?
Well, we look at the valuation discipline critically. Valuation discipline for us means that when we don't see any more upside in a company, we'll look at opportunities to shift that exposure towards a company with a more interesting upside potential and perhaps a more attractive risk reward. So that's ultimately what any investor should be doing, is focusing on whether a stock is fairly valued or not. But behind that conclusion on whether a stock is fairly valued or not is a lot of fundamental analysis. We forecast companies over 20 years to be able to capture the full runway of growth and to be able to capture the point where those companies become more mature. And we forecast in a very detailed manner both the top line growth potential, the profitability, the returns, the capital intensity, which leads us to a very clear picture of cash flow generation and cash flow growth profiles. And then we also look at each company across 4 areas of fundamental risks: industry risks, company risks, governance and sustainability risks, and portfolio risks. And by being so structured, consistent, and detailed, we're able to look at all fundamental risks that matter to any investment case at the company level. But importantly, we're also able to aggregate that data at the portfolio level. And I'll give you a few examples. We're able to then assess how much competition risk do we carry in our strategies, or how much disruption risk there is, or how much pricing power have the strategies have. Or when we look at aggregating the company risk profile, we can look at how much regulatory risk do we carry in the portfolios, where is it coming from, or how much cost-based inflation. Or a specific one that we pay particular attention to is accounting risk. Because for us, when we forecast companies and when we analyze them, we assess their accounting practices. And we have one golden rule: if we do not like the accounting approach of a company, no matter how attractive it might be or how interesting a market it is in, we will not invest. And that's a way of protecting our clients' assets from accounting wrongdoing.
When you're assessing a short list of stocks looking to buy, I imagine you'd look for quite some time before, in a concentrated portfolio, before making a move to buy. So what really are you looking for in terms of the attractive quality growth prospect? Is it total addressable market, brand? You mentioned pricing power. Is it valuation at the time, earnings momentum? And another thing, is it management? How important, you mentioned accounting risk. So does that come back to how you humanly feel about management when you meet them?
Yeah, absolutely. So the typical characteristics of businesses that we invest in through that framework that I just described end up operating in industries with high barriers to entry. They tend to have dominant market positions or the potential to become dominant. They have strong pricing power, and it's important in a higher inflation environment to find companies like that. They have low disruption risk, and we spend a lot of time assessing and stress testing disruption risk. They have structural growth prospects that we assess through that thematic lens that I mentioned. They have high returns on invested capital, strong compounding cash flows, and solid balance sheets. And then on the ESG side, quality management, strong corporate cultures, and sustainable business models. But at the heart of that will, attractive valuations. Those are the characteristics. So then when we go to the governance and sustainability assessments that we mentioned and that are part of that characteristics that I just mentioned, we're looking at 2 fields: governance and sustainability. We have 52 parameters that we're assessing for areas of risk. In governance, we look at board, management, remuneration, and culture. And so to your question on management, it'll be an array of characteristics that we're looking for. Management quality is one, and you're absolutely right. We only invest in companies if we rate the management quality as high. But there will be also an assessment of management depth, management breadth, management competence. We also look at their ability to manage through crisis. So crisis management as a field is something we assess.
How important is sustainability in this approach? You mentioned ESG factors, and I don't want to generalise about Scottish funds management, but you do get the feeling that the Scottish funds management industry was very, very focused on this long before it became a worldwide trend.
Martin Currie has been focused on sustainability for a very long time. We have expertise, we have various awards across different elements like the PRI. For us, sustainability is about managing shareholder value risk. And when we look at sustainability, we assess environmental risks, social risks. We assess how integrated sustainability is in company targets and ambitions, and who owns those targets, at what level. Is it at the executive, is it at the CEO level? And then we assess each company across 5 common factors, which are climate change risk, human capital risk, customer trust, taxation, and cybersecurity. And these ultimately, when you think about all of these risks, if a company doesn't manage those properly, it can impact shareholder value negatively. And then we can go into any of those. On the environmental risk, we assess pollution risk. We assess how companies manage the resources that they need for some of their productions. And on the social risk, we also spend a lot of time assessing social exploitation risk, where on top of the 52 parameters I mentioned, we have an additional 20 criteria that we're looking. And those criteria will be a combination of where a company is producing, are they in countries that are at higher risk of social exploitation? We look at their suppliers, because sometimes social exploitation risk doesn't lie directly with the company, but actually with its suppliers. But if you're a company that has a brand, you ultimately own the suppliers, because if there is an issue with social exploitation risk, it spills over into your brand equity and you get impacted negatively. And then we look at different types of social exploitation. So we look at wage exploitation, but also age exploitation, which is child labor, gender exploitation, and then religious, ethnic exploitation as well is part of that.
What's an example of a stock in the portfolio at the moment that you really like and a lot of viewers probably wouldn't have heard of?
Yeah, that's a tough question, James, because we're running high conviction concentrated portfolios of 20 to 30 stocks. So I always say all our stocks are high conviction, so they're all our best ideas. So I'll give you a few across the different sectors. At the moment, our largest position in technology is NVIDIA. It has become a very known company as being the 3rd or the 4th largest market capitalization globally now, given the stellar share price move. But this is a company we discovered years ago when the market perhaps couldn't spell the name NVIDIA. So it's a company that's really well positioned in the semiconductor ecosystem as a leader in the GPU space. So the fast computing that is necessary to harness AI means the company is really well positioned. And we equate it to the ASML of 10 to 15 years ago in terms of its position of privilege within the market, in order to, which enables it to capture that opportunity. So that's in the technology space. If we look at the consumer space, maybe we'll give the name of Ferrari. Now, Ferrari is everybody has heard of, but what we say about Ferrari is it's not a consumer discretionary, it's a consumer staples. It's a staple of the high net worth individual, true, but a staples all the same, because it's got such a predictable demand. And the reason it's got predictable demand is it's got a very long waiting list, more so than what they can produce. And therefore, every year they'll be able to produce at full capacity and deliver their sales, and actually they're very profitable sales in the auto space, which is typically low returns. This is a company that's high return. When we then move to the consumer staples, one of our company is L'Oreal in the cosmetic space, affordable luxury in other words. But L'Oreal has been able to continue to outgrow the market through its approach of being segmented in terms of brands, but also having good price segmentation and good channel access to the consumers across both online and retail. And then if we move to the industrial space, we would single out a company like Atlas Copco, which is a company that has more than covered its cost of capital, even through the worst of the global financial crisis of 08-09, which in the industrial space is difficult to find, and yet this is a company that's done so. And maybe finally, in the materials space, and industrial gases, a company like Linde, which is a company that in a cyclical segment actually has a fairly defensive business model.
Mm-hmm. And we touched on indices earlier, and I know you're not this kind of investor, but if somebody were to say to Martin Currie, no, look, I'm happy to hold my global equity allocation in passive form, what would the firm say to that person?
Well, we would say that there's so many opportunities in the market to harness businesses that the market tends to undervalue. And these are businesses that have attractive growth profiles in terms of both revenue, profits, dividends, and cash flow that compound over time, that have high returns on invested capital that are actually improving over time, that actually the ability of these businesses to outgrow the overall index is high. And therefore, that's where we find the opportunities in these compounding, high return, high growth companies. And we find that the market tends to struggle to value these businesses properly because it tends to underestimate the compounding characteristics. So what we would say to these investors is there are actually opportunities to generate excess return as an active investor. Typically, it needs to focus on good businesses, well managed, that have good structural growth profile, and have valuation discipline, and ultimately be long-term investors.
And the point about beating an index is to be as different to the index as you can make it.
You're absolutely right.
This has been a fascinating In-Depth with Zehrid Osmani, Senior Portfolio Manager and Leader of the Global Long-Term Unconstrained team at Martin Currie. Thank you so much, Zehrid.
Thank you, James.
It's a pleasure.